Good Wednesday afternoon to you. Welcome to the John Sanchez Show on News Talk KOH. It's a pleasure to be with you and a pleasure to be with my partner, Mr. Jason Gaunt. Happy Volatility Day, my friend.
Yeah, a little
Gosh.
de-risking into year end. There's some charts we can talk about today, but it wasn't a pretty day by any stretch.
No, sir. Not one bit. Very ugly day, actually. Not all that bad. I mean, I got to keep reminding myself. I don't know if you got to do this. You look at like a day like today, Jason, 228 point loss on the Dow, and you go, painful. But it was only, 0.47%, right? So we gotta put it in percentages. Got to put it in percentages to really feel the impact. But bottom line, yeah, bit of an ugly day today. We got a lot to talk to you about, as Jason just alluded to. We got a lot of things going on. We got this rotation that we've been talking about for the last going on well over a week now. This rotation out of AI related names, out of technology into consumer cyclicals and staples and utilities. And I mean, just a variety of different areas, but it kind of came home to roost today. And one thing that we'll discuss with you is Oracle, one of the companies, let's just say, that was going to be involved in a pretty significant amount of data center funding, i.e. $10 billion. The company backed out today. But then Oracle says, no, they didn't. And the company says, yes, we did. So we don't really know what happened. All we know is what the stock of Oracle did today, and it has drug everybody else down. But that's, as we have said over and over and over again, just a quick reminder, this is going to be the world, right, Jason, that we live in this new world of AI and massive capital expenditure spendings and so on and so forth. It's going to be just one story after the other. Some winners, some losers, and it'll go down in the history books, this period of time that we are in.
And I think you're going to look at your portfolios and value liquidity, right? When markets get volatile or you get down months or down quarters, being in areas where you can't get your money back tends to cause more angst, right? So Blue Owl, for example, this company that whether they are or they aren't giving Oracle money for their data center, remember they were recently involved in some sort of concern around their funds and liquidity in general. So I don't know that it's necessarily symptomatic of Oracle, maybe more of an excuse than a reason to pull funding. But a lot of these private credit, private funds that are doing a lot of the data center funding are going to be one to keep an eye on, right? As we've talked about, there's a lot of cash on the sidelines in a lot of these private credit funds, and they're willing to lend because they have to spend the money. The early stuff is good. The later stuff tends to be a little, I'd say less pretty. So data centers are, depending on who you talk to, either going to be building out for 10 to 15 years, or a shorter time frame, and it's going to become commoditized, right? Where people think that these data centers are going to produce so much capital and so much money. I mean, I'm of the opinion that they're going to continue to be building out for a long time. But it's just a matter of how much money are they going to produce, how much revenue, how much income are they going to spit off to these private credit funds, given all their costs too, of chips changing and technology changing. And are they going to be as cash flow positive as everyone thinks they're going to be? Or are you going to own a productive entity, but it's got a lot of costs on its side too? So it just plays well. You're going to, when the boo bears come out, when the bears come out, the scary stuff is talked about, the slowdowns and AI bubbles and head and shoulders charts and all this sort of stuff. But a week later, it's reasons to buy and this, that, and the other thing. So it's
weeks later, how about sometimes days later? Right?
Yeah. This is just a low volume time of the year too, right?
It is. Yeah. Volume is very
low. The
B
team is on the field for the rest of the year. So you have to think of that as well. The liquidity is going to get less and less as we near the end of the year. And I'm really of the opinion this is more of a deleveraging than it is a fear move with a S&P down 1% or so today.
Yep, absolutely. All right, so we do have a lot to talk about in regards to this big sell-off in Oracle, which again impacted the NASDAQ and the other major averages, et cetera. So we'll get to that in just a moment. First, let me tell you what we have lined up as far as our main topic, probably at the bottom of the hour. As we head into the final few, days, weeks of the year, we decided that this show today, after we go through our stock market recap, should really be devoted to you fellow business owners out there. Right? You've got a very narrow window to make some very smart tax moves. And you may be thinking, well, wait a minute, John, it's December 17th. How much, I don't have much time left. But you do. The problem that we find with a lot of business owners is you are so busy running the business, you're working in the business, you don't have time to work on the business. And what I mean by working on the business is the actual managerial side of it, right? The tax planning, etc. I mean, theoretically, you should have probably got together with your accountant like we did back in October and do your year-end planning and so on and so forth. Luckily, we're in the business and we kind of do a lot of things on our own and do our own planning and so on and so forth. And we'll share with you some of the things that we're doing that, again, we want you fellow business owners to be thinking about, like this great thing that we'll be talking about called a cash balance plan. But what we want to do today is we want to go through again some things that you need to be reviewing right now, from retirement plans, depreciation, income timing, entity strategies, so on and so forth. And Jason, I didn't get a chance to really talk in great detail about today's topic, Jason, but I just, I assume you have no problem opening the kimono a little bit on some of the things that we're doing, right? Because, I think we have a pretty solid plan with everything that we have going on with our firm. And let's share it with other business owners out there so they can kind of get an idea of what's out there. And again, keep in mind, leave your minds open, business owners. You do have time, even though it's the 17th of December, you still got some time. But that's why we want to get this topic out to you now, not next week, right? Where you really don't have much time left at that point. So it'll be a fun strategy. 2025 year-end tax strategies for business owners.
And oftentimes we're telling you what we do anyway.
We do.
We eat our own cooking for sure.
Yeah, we do. Oh, always. Yeah, we will never tell you to do something that we don't believe in or that we don't do ourselves. Never, 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 never. All right, Jay, let's go back to the stock market. So let me kind of just let the cat out of the bag what we ended up doing today. 38 loss on the Dow, 0.47%. We closed at 47,885. NASDAQ lower by 418, 1.81%. S&P down 78 points, 1.16%. All right, so let's go to, you mentioned it just a moment ago, the charts, right? I think that's a great place to start because, again, we had the 50-day moving average surrendered today in the S&P 500. 67.66 was the 50-day. We closed at 67.21. Take it away on the chart side.
Yeah, I mean, again, it's the technicals part. It's the psychology part where you start to look at some of these moving averages that were holding or breaking down through again on light volume. That people are pointing out the NASDAQ. People are pointing clearly Oracle, even S&P 500 to what looks like a bit of a head and shoulders pattern, which often can be a reversal.
Explain what that means
pattern.
To people.
Think of a head and shoulders, right? Think of the shape of a chart that looks like it's got a left shoulder, a head, and a right shoulder. We can do a teaching on a show sometime to walk through the reason, but it shows that it's running out of steam, that you tried to break higher and had a tough time doing so. And then
the head.
Exactly. The left shoulder ends up having the highest volume, the head lesser so, and then the right shoulder even lesser so. And then you will break down to the downside. Head and shoulders works on the bottom too. It's just a reversal pattern oftentimes. So people are pointing to these, doesn't mean they will happen. It just shows, again, the bears come out and draw a bunch of pictures during scary times, just like the bulls do when things are down. So it's not uncommon. But those tend to be things that people keep a good eye on, with not holding moving average support. And then you start to see some head and shoulders patterns. NVIDIA is one that I'm looking at as well. And it starts to at least cause some concern that if you do have a break lower, it could accelerate. The fear part is there now, with people talking about concerns around Oracle and data center and spending and NVIDIA and circular accounting, and all the parts are there to cause some angst, but doesn't mean that any of those are reasons to go puke these things, especially because names like Oracle are already down quite a bit from their highs. The fears priced into a lot of these stocks as well. It's not something you should be keeping an eye on, just like everything else. But as John mentioned, energy was higher today. Consumer staples were higher today. Utilities were higher today. There are always places in the market that are doing well when the high momentum names maybe aren't doing what you'd hope they were. So just a little bit of a rotation for sure.
It goes a little bit deeper. We're going to spend just a few more minutes when we come back from the break talking about this Oracle Blue Owl story. But there's one common denominator, Jason, between that and a common denominator between Warner Brothers Discovery and Paramount Skydance and Netflix. Want to take a guess what that common denominator is?
I would say liquidity. I would say bigger buyers.
A person.
Yeah.
Larry
Larry
Ellison.
Ellison, fair,
Yep.
sure.
Yeah. There's no way you're going to guess that one.
Yeah.
Yeah. This deal looks like, today you had Warner Brothers Discovery move down about 2.39%. Their board of directors unanimously recommended that shareholders reject the Paramount Skydance deal. It's a hostile takeover, noting that they do not find that it provides superior value to Netflix's offer. Nonetheless, Paramount reaffirmed its commitment to acquire Warner Brothers despite the recommendations. So you got Larry Ellison, again, founder of Oracle, and I think still the largest shareholder of the company. He was supposed to provide some financing because his son's involved in the whole Warner Brothers Paramount deal. He was supposed to provide, like, they want him to, I think, sign off on $75 billion commitment. And evidently he's not doing that. And so now many are going, well, wait a minute here. He's not funding this deal, even though his son's involved with it. Now Oracle just had Blue Owl Capital back out. Is there some problems? And again, down to the situation that we were talking about with Oracle. Again, $10.20 loss, 5.41%, 178.45. So I just thought that was like I said, an interesting common denominator between what's going on with Oracle, Blue Owl, and this Warner Brothers Paramount deal. So who knows if it's true or not? But just you got to try to put these dots together at some point, Jason.
Yeah.
Draw those lines. All right, when we come back, I got a fascinating story we'll share with you. I'm going to take it off of Bloomberg. It's going to go into some details much better than what we can paraphrase for you, because it is important. This Oracle situation has been pressuring the NASDAQ, pressured it again today. So let's give you some of the intricate details as to what's going on. First, let's turn it over to Kristen Snow. She's in the Right Now Traffic Center. Kristen, welcome back to the John Sanchez Show on News Talk 780 KOH with Jason Gaunt. All right, once again, we finished down 228 on the Dow, 0.47%. NASDAQ lost 418, 1.81%. S&P lower by 79.16%. Once again, one of the big culprits that we've been dealing with, of course, is AI and related stories, such as this Oracle situation that we discussed at the first segment. So bear with me a second, folks. I want to go through this article. I'll try to go quickly here, but it's just chock full of information to give all of you a little bit more insight as to what's going on behind the scenes with these data centers, right? These are massive, massive capital expenditures. But what you're going to find out is these companies like Oracle, they're just a lessee. They're not buying the properties. They're not building the properties. They are just going to sit back and write a lease payment, right? And Jason, before I get to the story real quick, throw in what basically you've been warning for quite a while now, that these companies really have no skin in the game other than, hey, we just signed on the lease. Well, you and I both know, we've seen it with a number of Wall Street firms. They don't like a real estate deal. If it's going south, they walk away, right? So bring up your concern real quick.
Yeah, the concern has been sort of twofold. One, with private credit funds in general, not to say that they're bad holistically, but they have a lot of cash that once all the good deals are gone, they tend to then go after the less good deals. The data center build out is one of those that depends on who you ask as to what the runway looks like. And as we've talked about in other shows, what the cost of capital is and how to find people to build them and all these, technology providers, and how much are you needing to pay each year or quarter or whatever to keep your technology current, and right. Whereas Oracle doesn't want to own that exposure. NVIDIA doesn't want to own that exposure. They want a holding company of some kind. Your Vertiv is one, for example, big data center company, right? They want to have someone else have that need to update all the information, and then they'll just utilize you and pay you a fee of some kind to rent tokens, rent space, rent data access. It's just, that's not our business. Our business is this. You go focus on building them and servicing them and keeping them going. And so that's the part that people were pointing out even today. How come they don't want to own it, right? Why don't they want to have their own?
They're not stupid.
Right. Think of all the spend and cost and such. So it again, not to say it's a negative, but you always want to be
something we just got to be aware of and talk about.
Right. So for sure.
The credit default swaps today on Oracle, highest closing level since 2009. There were concerns about the project and Oracle's lease obligations.
Yeah, and CDS is one of those things. Remember, it's just a credit default swap is just insurance on a bond, not much like a put on a stock. And it tends to overshoot as well, right? Where people crowd into it. And
other times it's been a good indicator too.
Yeah. Well, the more you buy credit default swaps, right? Think of the mechanism that needs to happen. Someone needs to hedge the exposure, right? So when I buy a swap from someone, whoever I'm buying it from, what do they need to do? Well, they can't short a bond So they would go out and short the equity. And that also creates downside pressure on Oracle. And then people say, oh, Oracle stock's going down, buy credit default swaps. And then they have to short the stock. So it's self fulfilling, it feeds on itself until you get a crowded short position and the borrow gets expensive. And then you can see those things reverse pretty quickly too. So just because there's high short interest, CDS going higher doesn't necessarily mean you have a dying animal. It just means that you've got tinder for a short squeeze too. So
well, I was gonna use a brush fire as an example, as an analogy, as you just said that. It'd be like an arsonist going out and saying, all right, I'm gonna light this neighborhood on fire. You know, I hate to be extreme here. I'm gonna light this neighborhood on fire, but before I do, I'm gonna go, you know, I've determined that Allstate Insurance insures the majority of the homes in this neighborhood. So guess what? I'm going to go short. Yeah, I'm going to go short Allstate stock because it's going to go down once all these fires break out and Allstate's on the hook. And oh, by the way, I'm going to buy some insurance, i.e. credit default swaps, you know, because, you know, to make money on that side of it too.
Yep.
Yeah, it's like, I love what you said, self-fulfilling prophecy. All right, well, unfortunately, we've used up that segment. So when we come back, I'm going to go to the story, and then we'll get into our end of the year tax strategies. Let's turn it over to Jack Saban. He's got news, traffic, and weather. Welcome back to the John Sanchez Show on News Talk 780 KOH with Jason Gaunt. Once again, we finished down 228 on the Dow, lost 418 on the NASDAQ, and lower by 79 on the S&P 500. Well, you know, this is one of the challenges of doing a one-hour show, folks, in our world, because we have so much to share with you each and every day. Sometimes we have to make a change, and we're going to do that today. We're going to table our original topic that we were going to get into right now, the year-end tax strategies for business owners, until Friday. And the reason being, we feel it's probably much more important right now for the rest of you to understand what's going on with the market right now, and specifically Oracle and this weakness that we're seeing in the NASDAQ. So I apologize, but again, we just have such a limited amount of time with you. So we'll cover it, like I said, on Friday. But in the meantime, I want to go to this Bloomberg article, Jason, because it really lays out what's happened today much better than you and I could paraphrase. So here we go. And stop me anytime you want to go a little bit more deeper here. So again, according to Bloomberg, it's becoming clear that even the slightest hint of trouble around data centers is enough to spook investors who are banking on the AI boom to power equity markets and provide a wave of debt deals in 2026. The latest hiccup centers around Oracle's financing for a data center in Michigan. Okay, folks, this was the problem today, okay? While it's largely moving along as expected, there's a key difference. Blue Owl Capital, a longtime partner in its rapid AI infrastructure build-out, is not contributing equity. That fact alone, confirmed by Oracle in a statement today, sent its stock into a renewed tailspin and put the cost of protecting its debt against defaults on track to reach its highest level since 2009. Even without Blue Owl, the Michigan project is so far progressing like others involving Oracle, according to people familiar with the matter. Blackstone is in talks to provide the equity capital, said the people who asked not to be identified, discussing a private transaction. In addition, Bank of America is leading a roughly $14 billion debt deal to help finance the project and is in the process of bringing in other banks and investors to join the commitment, people said. Oracle said final negotiations for the equity deal are, quote, on schedule without naming a partner in response to this article that broke today. I should have mentioned this earlier. Financial Times broke this story today. So in response to the Financial Times report early today that said the project was in limbo. A spokesman for Related Digital, which is the developer for the Michigan site, said the firm, quote, selected our equity partner of choice for their unparalleled expertise in the space. Full construction is expected to start in the first quarter. Representatives for Blackstone, Bank of America, and Blue Owl declined comment. Project finance packages are used. This is going to get into how these data centers work. Project finance packages used to fund the construction of data centers are typically structured so that 80% of the money comes from debt, meaning bonds, and 20% from equity. The data center site is usually owned by the equity investor and the developer, and that would have been, in this example, Blue Owl. Oracle is not the borrower, but instead provides a long-term lease to use the facilities, which create cash flow to make lenders comfortable with the deal. Oracle has used this form of off-balance sheet fundraising for other sites. A $38 billion debt package is backing the construction of data centers in Wisconsin and Texas, which are being developed by Vantage Data Centers. In addition, an $18 billion loan will be used for a new data center campus in New Mexico, where Blue Owl is providing the equity. In the case of the Michigan project, Blue Owl considers the lease and debt terms unfavorable relative to other deals, according to a person with direct knowledge of the matter. Those evaluating the deal were also concerned about potential delays in the project stemming from the state's political climate, the person said. A bipartisan group of Michigan lawmakers is seeking to repeal tax incentive for data centers. Governor Gretchen Whitmer earlier this month issued a statement in support of the Oracle project. Oracle said in a statement that Related Digital chose, quote, the best equity partner from a competitive group of options, which in this instance was not Blue Owl. While these mega construction loans may not be on balance sheet as debt, they're adding to massive lease obligations. Listen to these numbers. Oracle has committed the most money among the hyperscalers to data center leases, inking some $105 billion worth in just the 3 months ending in November, bringing its total commitments, these lease commitments of these data centers, to $248 billion. That's creating counterparty exposure across Wall Street. The cost of protecting Oracle's debt against default using derivatives, as we discussed earlier, has risen to nearly the highest level since the financial crisis. Banks providing the bulk of the massive construction loans for data centers where Oracle is the intended tenant are likely driving much of the hedging, according to a Morgan Stanley analyst in a recent report. So let's read that again. Banks providing the bulk of the massive construction loans for data centers where Oracle is the intended tenant are likely driving much of the hedging.
Yep.
Stop right there, Jason. This has got to have people spinning their heads. Okay, so John and Jason Bank, and we decide to be one of the lenders on one of these massive projects. But just to kind of make sure that Mr. Ellison and the rest of the crew at Oracle are going to make their lease payments, we're going to hedge this.
Yeah, short the stock or buy CDS. Like that's what I'm saying is it's self-fulfilling. Like it's creating the downside pressure with anything, right? Not to say it's not warranted, but remember, the bigger the deal is, like anything, you need to hedge it. And they don't hedge it casually, like let's do some.
Let's buy a few
right?
puts, yeah.
They literally are quants, right? They know based on their probability of failure, how many shares they need to sell in order to make sure if this happened, they would only lose this amount. It's like, it's all probability and payoff profile. So it's a massive deal to Oracle in terms of the amount of leverage that they're theoretically taking on. Therefore, the hedging needs to be a lot. Not to say that the stocks should go down, but in order to protect a position, I need to sell it. So I'm short and I make money if it loses value. In order to short it, you have to sell the stock, which pushes the stock down, which then creates more shorting because now my hedge is down. I need to be more short. So all of these things, I would argue that this is going to be a massive pop in Oracle at some point. It's not going to happen tomorrow, but at some point it will be more upside juice than it will be downside. They haven't done anything. They don't have some negative pot boiling in their cabinet that is just getting worse and worse and worse, like you and I were talking about offline. If they decided tomorrow, we're not going to do this, what's been lost, right? Like OpenAI is going to go somewhere else and
the credit rating would be
the stock's
shot
back to where it was. The credit rating would go up, right? Like
no, if they defaulted and they said we're not going to we're backing out of this
data center build out. Yeah,
$250 billion.
The stock was at $165 before they even started talking about AI a year ago, right? Or a year and a half ago. So it's basically back to where it was pre anything with OpenAI.
Yes.
Right.
Yeah.
So unless OpenAI implodes, and which could happen, I'm not saying it won't.
Well, that's
it
the
seems
path
like
I
the
want to go
worst
down.
case seems to be very much there, in my opinion.
Let's again, this is our job, right? Mm-hmm. We got to look at both sides of the equation. Mm-hmm. Let's go down that path. What if we always use this saying on this show, the cockroach theory, where there's one, there's 1,000 others. What if Wall Street's concern in regards to Oracle and their massive obligations to these leases, what if that expands to others, right? We don't know what's going on with OpenAI, the parent of ChatGPT. Just off the top of my head, I think they're very close, maybe even a little bit more, under the obligations for leases that they have signed, whether
way
it's
more.
leases. Yeah. Okay. Whether it's leases for NVIDIA chips or data centers or whatever. I'm looking at a chart right now between Oracle, Microsoft, Amazon, Meta, Google, and CoreWeave. These companies combined are on the hook for almost $600 billion.
And
Almost.
Oracle isn't paying for it out of free cash flow. And that's the
No,
difference between some of those,
that's right.
right?
That's right.
They need debt to finance what they're doing. Whereas Microsoft, Meta, these guys, Google, not to say that their free cash flow is always going to be there, but they're just spending it based off of revenue, right? Like the NVIDIA problem is they have nowhere to put it. But that's why Oracle is more susceptible to this pain, because they're doing debt financing, which is making their balance sheet look worser. And therefore, people are pushing it down and hedging. But like anything, you know how I'm always wired, right? Is if it's too obvious, it's too obvious. So doesn't mean that I won't be wrong, but I just think that, if you're trying to be opportunistic, I'm of the opinion that there's more negative priced in
Absolutely.
than hope. And so if you do have a positive view on data center build outs and the usage and the relationship with OpenAI and those types of things into the future, it wouldn't be a bad place to be starting to thinking about allocating assets to. Just my opinion.
Yeah, no, exactly. But I think, once again, to go back to my issue, which is we as investors, and especially you and I as portfolio managers, we've got to watch this and again, back to the cockroach theory and say, okay, you and I have, combined, we've been doing this over 50 years. You and I have seen this before, where all of a sudden Wall Street, in its infinite wisdom, right? You can't fool Wall Street. They pick out one company, right? It's almost like when I had a herd of cattle, right? You could always pick out the sick one, right? And all the others you could have a herd of, 50 cattle, and there'd be that one sick one in there. You can pick it out. That's the analogy that I'm giving, that maybe Wall Street is looking at Oracle as that sick heifer right now, right? And it's sitting there by itself, but it knows that maybe other companies, i.e. other cattle, are going to get sick.
Yeah,
right?
I would say.
How can this be unique to just Oracle?
I would say short the other ones if that's your view.
Right.
If Oracle isn't your place to go think you're going to go kill it. Like if you're of the opinion that Oracle's going to die, I'd be shorting NVIDIA, I'd be shorting Meta, I'd be shorting Microsoft way before I would get myself to.
But that's kind of what, that's what Wall Street's doing, right?
Sure.
I mean, Google was down $9.67. Tesla, roundabout way, it was down today, $22. Let's see, what did we end up doing on NVIDIA? Down $6.43. So, to your point, others out there may already be doing that, right?
Cool. Yeah, absolutely. Yeah. I mean, that's why you're a hedge fund, right? You can short things and buy others, right? It's pair trades, right? Trade one stock to the long side and short something else. Like, this could be one that if you think it's going to reverse, this one will reverse hard. Versus, some others may not bounce quite as much because they haven't felt as much pain.
Is this a dream environment for a hedge fund?
They tend to start pulling back leverage when things get bumpy versus lean in, right? But a tech hedge fund, probably yes.
Yeah, exactly. All right. We'll continue our discussion when we come back. Let's wrap it up with Kristen Snow right now, Traffic Center. Hello, my dear. Welcome back to the John Sanchez Show on News Talk 780 KOH. If you missed any of our shows, please, as a reminder, go pick up our podcast or find us on YouTube. All right. We've been talking again about Oracle and kind of leading the NASDAQ lower, say that tongue in cheek, but a major catalyst to the NASDAQ moving lower. Again, the situation that happened today with Blue Owl pulling out on funding one of the data centers, but then Oracle saying, hey, we got other people and Blackstone coming in and so on and so forth. Jason and I were talking off air, and Jason, why don't you just for the heck of it kind of share, unless you feel it's proprietary, I think you're fine, some chart pattern information that we were just working under.
Yeah, we were just looking at the correlation between Meta, Microsoft, Oracle, NVIDIA, and clearly they have a lot of similarities. I'd argue Oracle and NVIDIA look the most similar, and then Microsoft and Meta look the most similar. Microsoft and Meta would be the healthier of the two charts in terms of how they've been acting most recently.
The chart pattern is down for all of those in the last.
I mean, again, it's not. But Oracle, I think, was 40 some odd % off of its highs.
Mm-hmm.
And like I said, for all the full disclosures, do your own work. I'm not telling you to go buy anything, but this is just an example of ways that we look at stuff and think of things as to ultimately, if you do your work, you want to buy when everyone's scared, right? Not buy when everyone's super excited, because that tends to be the top. So just something to sniff around at. But yeah, it's just like charts like this when it feels as if nothing can go right.
Mm-hmm.
And that seems to be one right now.
If you think you had a bad day today also, here, I'm going to lighten it up a little bit, but stay on topic. 3 months after Larry Ellison became the world's richest person. His net worth has now dropped with a decline in Oracle stock, $24.9 billion.
Do you see Elon Musk now? He's like 700. Like, it's bananas how much money he has.
More.
Like $700 billion. He's like worth like as much as, I forget they were saying like Jensen Huang, Larry Ellison, and like someone else. Like, he's all together. I mean, just in Tesla's move.
Yeah, that stock's been...
Guy's amazing, honestly.
It really is. Really is. All right, so let's wrap things up with, hopefully we got you thinking a little bit here today. And again, I apologize for you entrepreneurs. We will, again, get to our year-end tax strategies on Friday. But let's kind of wrap things up a little bit with our advice as to what we should be doing at this point. Because most of our listeners, Jason, let's face it, I'm sure they have the Oracles and the Amazons and the Metas and so on and so forth. And of course, NVIDIA, et cetera, in their portfolios. They may be a little bit nervous right now.
Sure. Yeah, I mean, if you're a little bit nervous, good. That means that you're engaged. But at the same time, too, if your portfolios are moving more than you're comfortable with, you may be too large, right? You can go and look at your favorite, S&P 500 ETF and see how big each of those stocks are as a position in the S&P 500, and that might be a decent a barometer for how big it should be for you as on the high side. Right. So, that's oftentimes what I'll go look for people, because if it's too concentrated, yes, you've made lots of money, but you can also lose lots of money very fast. So
there you go.
Good time to be reallocating if you're concerned.
Still, even with all the volatility in the last few days, up 17.5% for the NASDAQ year to date. S&P's up 14.3, Dow at 12.6, Russell up 11.9. So we still got some very solid gains hanging on going into the last few trading days of the year. Great job, Jason. As always, we'll do it again tomorrow on the John Sanchez Show. God bless. Have a great afternoon.
John Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.